Sacramento Association of Realtors for giving me the opportunity to present to you 7 tax mistakes realtors make. And I truly believe that if you will give me the next 40 to 50 minutes or so, then not only can I present you and will I present you with money-making strategies, but also how to protect that money this year, 2018. I believe that these strategies will allow you to keep at a minimum $10,000 in extra money in your pocket every year, because in my experience, many realtors are good at making money, and you're like, well, I'm not good at making money. If in this real estate market, you're not making a lot of money, then I don't know what to tell you, except every realtor that I know is making money hand over fist. I mean, there's closings galore. You just close your eyes and point, and there's a closing happening like every handful of minutes everywhere throughout the greater Sacramento region. But I believe that these strategies will help you keep or make an additional $10,000 in 2018. So if you'll give me a few minutes, I will save you or get you to earn an additional $10,000 in 2018. And I also believe that it will help you make an additional $100,000 during the course of your career. How many would like an extra $100 grand during the course of your real estate career? All right. If you didn't see their hand go up, then they lie about other things too. So, who am I? My family, the Ornelas family, has been proudly serving California residents for 3 generations. It started with my grandfather, Mario D. Ornelas, who during the Great Depression started a shoe shine stand in downtown Los Angeles, and his motto was a nickel a shine. He did so well that he was able to hire his brother to help him out and shine shoes for a living. It was a statement of pride for my grandfather to say that he did not stand in a breadline one day in his entire life or during the Great Depression. He was an orphan. He only had a 5th grade education, but he became a foundry man and manufacturing aluminum. He also became a real estate investor, and by the time he retired, my grandpa was living off a measly 1% that Bank of America was paying him on his savings account, that for some reason they never offered him the opportunity to upgrade. And he was living off his little Social Security and the 30 grand or so that his savings account was earning at 1% every year by the time he retired. I was mentored by my dad, a former franchise tax board auditor. When we were kids, we traveled up and down the beautiful state of California. So we've been east, west, north, south, and all points in between. He used to audit small businesses for a living. So he was on the government side, and then he came over to our side, helping us out, the taxpayers. He mentored me in taxation and what auditors look for and how to avoid triggering red flags. He taught me how to be a tax nerd when he started the business in 1992, and I got my start because one day my mom asked me if I wanted to get some candy, some ice cream. What kid doesn't want to get some candy or ice cream, right? And she said, you see these numbers on these pieces of paper? If you will type them into the computer over here, then I will give you money to go get some ice cream, dip candy, whatever you want. Little did I know that she was actually getting me to do her job for free. Tricked me into it. I've been in it ever since. So who am I? I am the author of 7 IRS Secrets Real Estate Professionals Need to Know. I have worked in the tax industry since 2004, proudly representing clients throughout the great state of California. I specialize in helping real estate professionals, realtors, brokers, investors, and so on, get and keep the IRS off the back through proactive tax strategies. The IRS, probably the most feared 3 letters in our entire alphabet. And if not, then you should be afraid, be very afraid. Why? Because under our federal laws, they have a limited power to get the money. Get the money. 3 little words. When you see IRS, it means get the money. And that's what they're trying to do from you and I in every opportunity possible. They've been limited to doing that because they've been experiencing budget cuts and layoffs, and their commissioner was forced to resign due to scandal. But they have a new commissioner who's now running the game, and he says that he's out to enforce collections. Ironically, he used to be in the tax representation industry as a self-employed attorney. So he switched roles. He was role reversal with my dad, who went from the government side to our side, and he went from our side to the government side. Go figure. You ask, what is an enrolled agent? What does EA, those magical two letters, mean? Basically, an EA is someone who's looking for a tax specialist in professional tax preparation and tax advice. Because we've undergone a comprehensive IRS exam that covers individual, business, and IRS representation. We are required to undergo 72 hours of continuing education every 3 years to keep our licenses active, in addition to passing a background check. This morning, I'll be talking to you about 7 tax mistakes realtors make that fall into these categories: mindset, strategy, and collaboration, as noted in parentheses. So let's talk about mindset. The first tax mistake realtors make is giving up on closings with tax liens. Isn't it true that you get paid when escrow closes? You get your commission when escrow closes. But what if the buyer or seller has a federal or state tax lien on their record? What happens? Yeah. Usually nothing. I've met with and talked to realtors who had their escrows canceled because they found out that the buyer or seller had a federal tax lien. I've talked to realtors who were scared. They didn't know what to do about their closings to get their commission check, so they would rather have somebody else handle it. I spoke to a managing broker just last week who was investing in a piece of property a few years ago, and he so badly wanted that property that he shelled out $18,000 of his own money just to get escrow closed because the seller had a federal tax lien. Chris asked me, who's the managing broker, if I had called you, could you have helped me in that situation? I said, it depends. It's good accounting, tax cop-out. It depends. It depends on the situation, see, because in that situation, we would have to look at your transaction and we would see both parties and what was involved. But there is the likelihood, and we have successfully negotiated the removal of tax liens for various realtor and real estate professional clients. Something that we find pleasure in and we take joy in doing. So Fannie Mae requires that there be no tax liens on either party, plus 1 month in a payment plan or an installment agreement with the IRS to close escrow. There is a way to make sure that you get paid, so it's my encouraging word to you for the day that you don't have to be scared when you see that there's a federal or state tax lien. That usually just means that escrow is going to take a little longer than anticipated. But hey, when does escrow not take longer than you anticipated, right? We're going to close on Tuesday. Oh, it looks like we're going to close on Friday. Why? Because we had a discrepancy in the documents. Basically, an escrow officer slept in that day. Anyway, I'm not here to pick on escrow. Second tax mistake realtors make is limiting commissions for fear of increased taxes. Many realtors limit their commission earning potential because they don't want to incur a larger tax liability. So I want to admonish you not to limit your commissions because of an increased income tax bill, but to make as much as possible in 2018. I spoke with a realtor the other day who told me that she had taken a wage earning job and had limited the number of prospects that she met with, limited the number of open houses that she did, and limited the number of commissions that she earned from real estate closings just because she did not want to pay more in income tax. Somebody said that income tax, or tax in general, is the price we pay for living in a free and civilized society. So if you have a higher tax liability, a lot of times it means that you earn more money, or you screwed up royally. But in any case, it usually means that you made more money. So the new tax reform which is a discrepancy. It's not really tax reform, because I've been hearing that term tax reform thrown around since I was a kid, which, if you didn't know, was when Reagan was in office. And they've been throwing that term around for years and years and years. The postcard thing, hate to break it to you if you're in favor of it, not going to happen. Basically a great way to get your identity stolen. Anyone want to make it easier for people to steal your identity? Did anyone see the news just this morning? Mark Zuckerberg, CEO of Facebook, apologized to the public because he leaked, not he, but Facebook leaked and sold millions and millions of people's information to data analytics firms. It would be a miracle if he actually issued a refund for the money that they paid Facebook, but hey, maybe an apology is as best as we can get. But the whole postcard idea essentially makes it easier for people to steal your identity. Why would we want to make it easier for people to steal our identities? I don't know. But anybody who tells you, yeah, let's simplify the tax code by putting it on a postcard, it's either wishful thinking at best, hope, or they were born in the barn and they have no idea what's going on today. Maybe they're Amish, they're on TV, I don't know. But the Tax Cuts and Jobs Act gives us a 20% tax deduction on your self-employment income. It applies to pass-through entities and it includes rental property. It excludes wages. So if you are a Schedule C filer, if you have an S corporation, if you have a partnership, you have an LLC, then it applies to that income. So you have your gross commissions minus your expenses equals your net profit, and once they calculate the tax liability, the self-employment tax on the 15.3%, then they boost your net profit by an additional 20%. So if you've heard people say, oh man, meals and entertainment is going away, well, big deal. They're helping to make up for it. And essentially, when it comes to meals and entertainment, we usually spend more than we should have, or than we wanted to anyway. So maybe pack some PB&J, ham sandwiches, or bologna. Save yourself a little bit of money because it's not a write-off anymore, meals and entertainment. This deduction phases out on net business income if you're a single filer of 157.5 pass-through income, and if you are a married joint of 315. So you can make a whole lot of money before you lose the benefit of the new tax deduction. Congress is still finalizing that deduction, but they claim that they're going to have it finalized and all the details sometime in the summer.
When you say phased out, is that scaled in at different earnings levels, or is it all once at those thresholds you put up there for single married?
It phases out as soon as you hit that threshold. It starts to.
So there's no
increase.
incremental, or it just starts to phase out?
Starts to phase out, yes. Second, next, let's talk about strategy. And if you have questions as I go along, feel free to write them down because we'll have a full-blown question and answer session at the very end. So if you raise your hand, then I'm not ignoring you. I'll give you a signal like this. That just means write it down and we'll get to it at the very end. Fair enough? All right. Strategy. So pay attention because this next strategy could cost you $5,000 to $10,000 per year. And third tax mistake realtors make is structuring their businesses wrong. So let's talk about the types of business entities. The first one is the Schedule C. This one's straightforward. It attaches to your personal income tax returns, just another form on it. You incur all of the liability legally and tax-wise. There's no shelter, no protection, no nothing. It just comes directly to you. Usually you just file a DBA with the county recorder's office and they get you set up and you're good to go. And it's easy to set up, but it comes with the highest audit rate of any of the tax and business entities. Matter of fact, the IRS loves Schedule Cs. They eat Schedule Cs for breakfast. They consider Schedule Cs low-hanging fruit. Why? Because if you're a Schedule C, they can come right after you. And usually if an IRS agent, IRS auditor does just a little bit of digging, they can find stuff to disallow, to reject, to turn over, costing you hundreds or thousands of dollars in additional tax. So, if you're a Schedule C, then be afraid. LLCs, pass-through entities, it's a limited liability company. This carries no federal tax effect. It's mainly for legal protection. So it gives you a little bit more legal protection than a Schedule C, but it carries no federal advantage. For tax purposes, it must be treated as a Schedule C, a partnership, or a corporation to be recognized. The IRS considers it a disregarded entity. They don't recognize it for federal tax purposes. Next is the S corporation, which you file on Form 1120S. This is a tax election. You notify the IRS, I want to be treated for tax purposes as an S corporation, subchapter S, or S corp for short. It's not a legal structure. You don't file any documentation with the Secretary of State or the County Recorder's Office. This is just something that you notify the IRS that you want to be treated as for tax purposes. The good news is that it avoids the double taxation that corporations incur, and it has to be a small business. You can only have up to 100 total shareholders. Next is a partnership, which you file using Form 1065. It's similar to Schedule C for tax purposes. It provides a little more protection than a Schedule C, kind of similar to the LLC, but it's similar to a marriage in that partners can be held liable for partners' debts. So here's how it goes. If you are in a partnership, 50-50 partners, and your partner signs his or her name to a loan without telling you, you're still liable for 50% no matter what. There is no plausible deniability. There is no, oh, I just didn't know. Doesn't matter. You should have known. So even if your partner got crooked on you and signed up for a bunch of credit cards and loans and jacked up the total amounts due, still you are going to be liable. And they can and they do come after you. Similar to a marriage in that I have not seen a partnership be in the middle. It's either very good, everybody's making money hand over fist, everybody is closing sales and opening up new locations and hiring employees, or it's very bad. They're firing employees, transaction sales didn't work out, they're downsizing, they're canceling their office lease agreements, and each partner is at each other's throat. Usually does not go down pretty. So make sure before you sign up for a partnership or get into something or believe what your Uncle Bob or Aunt Jane tells you, oh, just sign your name on this document real quick because I want to give you a share of these profits. Make sure that you know what you're getting into before that. The next one, fourth tax mistake realtors make is guessing mileage. Show of hands, how many of you track your mileage on paper, on an app? Ah, all right. So whatever works for you, make sure that you track it. But here's the deal, is don't just track the business mileage portion, track the personal too. Why? Because it has to be consecutive. For tax year 2018, you get 54.5 cents per business mile driven, but it has to be consecutive. This is one of those low-hanging fruit items that IRS is coming after realtors about. So a lot of realtors tell me, oh, I've never been audited. Have you ever gotten a request for more information or a request to prove a deduction? Then you have been audited, only by mail. The thing is IRS wants to put a nicer, more friendly face on themselves. So they're not calling it an audit because they know that people will freak out, they'll panic, right? They want to provide the documentation. They want us to be nice, compliant taxpayers and give them the information that they're requesting. So they didn't call it a mail audit, they call it a request for more information or proof to support your deduction. So whether it's paper or digital, make sure that you track it some way, somehow, whatever works best for you. If it works for you, then it works for you. I met a gentleman, he's in his 80s, he has tracked his mileage for 50, 60 years. He even includes the time. So what an IRS auditor or agent will do if that agent saw those logs would say, oh, sir, it looks like we made an error. Sorry to waste your time. Because he has proof to support all of his business mileage. So without proof, IRS many times will disallow the business mileage that you could not prove. So, and proof doesn't count, your word doesn't count as proof. So if you say, well, I think that I did this much driving or incurred this much mileage, unfortunately, even though I might believe you, that doesn't count. So here's a proper business mileage entry. Starting mileage 15,001, ending mileage 15,025, the date, the business purpose, and who you were with. If it's a meeting of some kind, then you just include a blurb about what you discussed possibility of working together, developing a joint venture, whatever it is that you discussed, put it in there and you are good to go. Here is a proper personal mileage entry. Notice that it doesn't include all that detail. You just have to have the starting and ending mileage and tag it personal and you're good to go. You don't have to say what you were doing. You don't have to say who you're with. Any of that stuff, it's none of their business. Don't forget to track volunteer mileage. A lot of us volunteer for our kids' school, kids' sports teams, for scout meetings, for extracurricular activities, for church, or your work is having a community outreach event. Make sure you track that mileage too, because even though it doesn't come out to be a heck of a lot of money, that's extra money just sitting around waiting for you to get your hands on it. So why wouldn't you get extra money that you're entitled to? 14 cents per mile. So if you drive a couple thousand miles, volunteer mileage, which is not abnormal, it's not unusual, then that comes out to about $300 in additional deduction for you per year. So why wouldn't you get your hands on additional $300 per year just because you track your mileage? The app that I recommend is Mile IQ if you don't use your brokerage's mileage tracking app, or if you guys don't have an expense tracking app. I can't recommend this app enough. If you use my promo code, which they give in exchange to me for a discounted rate on the app itself, that you'll save 20% per year. It comes out to about the cost of a cup of coffee. Fifth tax mistake realtors make is filing tax returns and estimated tax payments late. Annual estimated tax payments must total 80% of your prior year's tax liability. So for example, if your prior year's tax liability was 10 grand, then your current year's estimated tax payments for the upcoming tax year have to total $8,000. I met a realtor lady the other day. She told me, oh, I never pay estimated taxes. I said, why not? And she said, well, because they're just a waste of my time. I mean, to go online or to drop the voucher in the mail with a check or whatever, just big waste of time. She said, well, Marisol, let me take a look at your tax return. You see this right here? You paid the IRS an additional $5,000 just because you didn't make estimated tax payments. They charged you $5,000 in additional tax just because you didn't drop your check in the mail or pay online, whatever. Does that make any sense? And I said, would you like to keep an extra $5 grand in your pocket every year? This money is just leaking out of your pocket just because you're being obstinate and for no rhyme or reason. Why would you even do that? Like, just go along with the program and you'll be fine. You'll be good. You don't have to pay quarterly. You just have to make sure that your annual estimated tax payments equal at least 80% of your prior year's tax liability, and then you are good to go. The annual underpayment penalty of estimated taxes is 16%. That's a pretty high interest rate that you're giving the government additional money just because you did not pay your estimated taxes in a timely fashion. The timely is by January of the following year, the total equals it. So I usually recommend that clients pay quarterly, save their money monthly, and then just have those reminders. Set it in your Apple Watch, set it in your phone, put Post-its everywhere, whatever you got to do to remember it, but just make sure that you do it. I don't recommend auto debit because then you give them access to your account, and I don't usually recommend that. Unless they're putting money in there, then hey, why wouldn't you get your money faster? So don't pay them free money. I mean, I know we all love our government, right? We all love our government. We all love living in a free country. I met a guy from Brazil recently. He told me that half the time the trash man doesn't even pick up our trash. Now, every trash day the night before, the trash guy comes without fail, right? Can you guys remember a time when the trash guy did not pick up your trash? I can't, right? And if he did, then everybody would be up in arms. But he said half the time they don't even come. So our trash just piles up there in our neighborhood. And I said, well, isn't Brazil a free and civilized country? He said, well, that's what they tell you, but not really. So why give the government any extra money when you don't have to? I mean, I know we all love living in this country. I know I do. The opportunities and privileges that come with being an American are great. But why would you give the government extra money just because? It just doesn't make any sense. You must file your tax returns by April 17th, 2018 for tax year 2017 if you've not filed already. If you're filing an extension, then you have until October 15th to file your return. Filing an extension does not give you additional time to pay your tax liability. If you pay late, you get penalized. You get interest, you get late payment penalty, you get underpayment penalty, and all these additional penalties get triggered just because you paid 1 day or 2 days late. So make sure that you pay on time with your extension, mail or online, it doesn't really matter. Just make sure that you get that in on time. Mentioned earlier that Schedule C tax filers are the most likely to be audited. Nina Olson, the taxpayer advocate, said this in January. The IRS states that the audit rate is 0.7%, but in reality it's about 6.2%. 0.7% is around 1 million taxpayers. 6.2% is about 6 million taxpayers. So there is the possibility, there is the likelihood that audits will increase, especially with a new commissioner. Money Magazine said the odds that your return will be audited triple if you submit a Schedule C to claim business income and expenses, and they increase almost, get this, tenfold if your business income is over $100,000. Which is realtors, it's pretty easy to do. Next is collaboration. 6 tax mistakes realtors make, which I talk to managing brokers on a regular basis, and they pull their hair out over this one, is giving tax advice. Giving tax advice. See, I knew it. Just because you could does not mean you should. The National Association of Realtors Code of Ethics, Article 11 states, realtors shall not undertake to provide specialized professional services concerning a type of property or service that is outside their field of competence unless they engage the assistance of one who is competent on such types of property or service. Further, California Civil Code Section 2079.16 states, buyers and sellers are expected as a matter of public policy to obtain tax advice from competent professionals other than the real estate brokerage handling the transaction. So folks, that is not legal advice, it's just a heads up, a CYA. You can get in trouble left, right, and the other. How do I know that if you give your client bad advice, guess who the first one they throw under the bus is? Not themselves. You, right? Because what happens is they say, oh, Mr. IRS agent, I didn't know any better. I'm just an unsuspecting citizen. I had no idea. I don't know the tax code. I'm not a tax professional. But my realtor over there gave me that advice. So that's why I did that. Really, why is your realtor giving you tax advice? I have no idea. I'm just an innocent victim. By the way, here's her phone number, address, email address, office address, kids' names, dogs' names, everything. What do you want? I got it. Here you go. Here you go. You'll be the first one they throw under the bus because, according to IRS standards, you're a professional. You should have known better and not ventured outside of your realm of expertise. Clients ask me on a regular basis for legal advice. I tell them I have no idea, except to send you to a competent legal advisor, a competent attorney who can help you out in that situation. I'm not going to do legal advice. I'm not an attorney. They come to me and ask me for real estate advice. I tell them, you know, those are great questions. I'm not a realtor. I have no idea. Those are good questions you're asking for a realtor. Go ask a realtor. Go ask a realtor. So when it comes to, I know a lot of times we are afraid of not knowing, right? So we use our handy little friend G over here, Google. Pop it into Google. Oh, that looks good. All right, so I'll tell my clients, yeah, this looks good. I'll just copy and paste a few things and then kind of memorize it, and I'll be good to go. Anyone ever Googled something because you're trying to build something, fix something, do something, whatever? Watch a YouTube video or two, and whatever it is that you were trying to do ends up taking you longer afterwards than before? Well, with such a complicated subject as income tax, There are a lot of potential ramifications of any advice that you give. And if the client snitches on you, the IRS will give them about 25% of whatever liability that they get you for. And what happens is once you're under the red flag of the IRS, you're always in the red flag of the IRS. It's like they resent you with a passion. Anyone ever had a bad experience with a client? No? Okay. So you just got your license last week. I understand. Okay, good. But congratulations. Welcome to the industry. But if you have ever had a bad experience with a client or working with a professional or just with your family, right? Every family has drama. Every family has politics. So if you've ever had a bad experience with anybody, then you know that given the right or wrong, depending on how you look at it, situation, people are likely to take it out on you, to throw you under the bus and get you in trouble. So just stay away from giving tax advice. If you encounter a client of yours who says, Ms. or Ms. Realtor, how do you calculate basis over here? How do I treat this? Can I claim him or her as a dependent? Blah, blah, blah. That's a great question for a tax person. Let me go ahead and give you my card. He'll take good care of you. I'm not qualified to give that advice. Anything real estate, I'll be more than happy to take care of you. But this is outside of my area of expertise. And I want to make sure that you get the best service possible. This last mistake realtors make could cost you at least $100,000 during the course of your career. Again, a show of hands, how many of you would like an extra $100,000 in your pocket during the course of your career? All right, great. And anybody else? Like I said, they'll lie about other things too. 7 tax mistake realtors make is not hiring a competent tax advisor or doing taxes themselves. Zig Ziglar said, if you've got a tax problem, why not go to a tax expert? Because you could become one, but it'd take years and it's a lot easier to let him do it. U.S. News and World Report recently stated small business owners and the self-employed can be subject to complex rules regarding work deductions and filing requirements. Although business tax software is available, the risk is people might overlook tax write-offs because they are unfamiliar with the tax code. USA Today said by signing your tax return, you are responsible for all the information on the forms. If you do your taxes yourself, that means you're the one the IRS will come to with any questions, possibly years, up to 7, after you file. A tax pro, however, can be your point person. Although you can find highly trained tax experts who work for tax preparation chains, most of their tax preparers are seasonal workers who have a few weeks of training in how to fill out tax forms. Many simply enter your data into a form, which is really just a small step above do-it-yourself tax filing software. And even this simple task can often go wrong. In a Government Accountability Office study, which is the watchdog over the IRS commissioner reports to those guys, GAO staff posing as real taxpayers worked with different tax prep chains to gauge their accuracy. In all 19 of their visits, that's a lot, the tax preparers made errors, some that would have cost the taxpayer $1,700 of his refund. That's a lot. Other mistakes led to refunds that were $2,000 too much. You're like, what's wrong with that? Getting more money? That's good. No, it's bad. Because if you overpay someone, then you want that money back, right? IRS is the same way. They want that money back. You'll get a letter a few weeks later saying you owe us. If these mistakes had been made on actual taxpayers' returns, many of the preparers would have been subject to penalties for negligence and willful or reckless disregard of tax rules. You have better options. That seems like a pretty big risk to take just for the sake of convenience, especially when there are better choices available, and Roll Engine being number 1. That's Dave Ramsey. So today you have 2 options. You can handle your taxes yourself and end up like this. Second option is hire a competent tax pro to handle your taxes and end up like this.